Hi, today is Monday, the 6th of April, and this is the SPX Outlook for the coming week. Last week was relatively quiet compared to previous weeks, and if you have watched the last SPX report posted exactly a week ago, I mentioned that the 2500 would be a strong pivot level. It is sitting right here. And indeed, it acted more or less as anticipated. If you remember, I said that that pivot level will determine the range where the market is likely to hover around. And a pivot level determines generally the range above or below. Obviously, it is obviously not an exact science. And I also look at fib to see whether there's convergence of levels, and in this particular instance, the range, this is a 1 hour chart, so you don't see it all, but the range from the recovery around 2200 to 2650 plus minus shows a fib level around 2465. There's a lower fib on 2410, and the last one is on 2355. Because there's not convergence, there has been hesitation between the fib and the pivot, but overall this is still valid. From April 2nd to, basically the whole week, the market tested 2500, 2465, dipped even lower to almost hit the 2410. But overall, besides those little sellers induced spikes, this is still valid. And futures have reopened Sunday night, and it looks like we're going for another recovery day. Will it go up to the 2650? I don't know, but it is likely that after a while this range will prove to be strong enough to reassure buyers. So this is the 1 hour chart. Of course, it doesn't give us much of a outlook for more than a day. So let's switch to the 4 hour chart, which probably will give us a better idea for the next 2 to 3 days, maybe up to midweek. Here we see that fib pattern 2175 to 2640. It should be slightly lower. The highs were slightly lower, so let's place it there. With the current volatility, plus minus 5-10 points doesn't make a difference at all. So maybe at some point I will have to plot an expansion pattern going upward. So for now, we see that the market is signals up. Market could definitely go and bump in this area to see whether the crisis is finally over. A high low from this terrible drop to 2200 would definitely signal that it's time to get back in the market. Volumes have been slightly better, I would say, but it went down to a trickle, probably like a 10% of normal volumes, and now it's back to 20-30%. So market conditions are not normal yet. However, trading has been comparatively easier with market makers taking the mid, more or less the mid. Previously it was more on the mark and you had to really break down the combos to simple spreads or even individual options. Now what we're seeing is that here again, and there's obviously no much difference between time frames, the patterns are more or less the same. So here again we see some possible bullish congestion up to 2650. And if we now have a look at the daily chart, same pattern. Here we already going almost to some overbought mode, so it could really bump there for a while, and we can't discard that a breakout on the upside could definitely signal more buying. Let me draw a fib pattern on this one. This is not a coincidence that the first fib is exactly there on 2650. So can we see 2790? Possibly, but I don't actually see it coming in the next few days. But yeah, there are elements of a potential recovery to probably 2800 by end of the month. So overall, for those like me who still have April open, this congestion is good. Volatility is still relatively high, still holding. The VIX is still in the 45-50, so we're definitely not out of the woods. But I would say that if 2500 holds, it will be likely at the market trying to cover, meeting more and more sellers, and we could have some congestion at least until the end of the week. The day range, if you look at ATR is still pretty high. We are looking at an ATR of about 165, which is quite high. And If we look at a VIX, let's take it as a proxy for ETMID over 30 days. The VIX probably predicts a 1SD day range of maybe around 120 points, 60 points. 1SD is probably 60 points up or down. Let's not forget that volatility is not a directional indicator, and of course it can go either way. The market is still affected by the huge volatility. I posted for members of the class a short note on Wednesday showing that in this environment, Black-Scholes does not work very well. Black-Scholes does not take into account large sudden moves. It's not a jump diffusion type of model, and not only that, but it kind of assumes a skew. Let's say kurtosis is around 3, skew about 0 to slightly positive. And at the moment, if you read that post, we are in extreme measures. So technically, the Black-Scholes should be compensated. So market makers and us, mere mortals, just retail traders, we are affected by the difficulties in modeling it. But that being said, if the market stays in this range and volatility starts abating, Black-Scholes will do a better job. It is likely that it is exaggerating risk. If we would plot IV versus realized volatility, there's probably very good opportunities for market neutral traders. Volatility makes our positions pretty cheap. Volatility is sold excessively, so that excess price should be an opportunity. That said, with the difficulties in modeling properly, I would be cautious about seizing those opportunities. In addition, as we're going to see in the next video for members of the class, the capital constraints, if you are strict in trading within planned capital limit, it's actually difficult to reallocate because we are kind of stuck with current positions. Okay, that is it for now. Next video in a few hours on our trades. Thanks for watching, and bye for now.